The next 48 hours are critical for the market. After breaking out of the do-or-die zone on Monday's gap up, markets have failed right back down into the zone. So if the short-term low is going to hold, and this is ultimately the bottom, then buyers must defend the gap fill reversal level into Friday. Otherwise, buckle up for some new lows. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY weekly time frame chart. And admittedly, the weekly bar has not officially closed yet. This is in progress. It is subject to change. However, you can probably already see the concerns that are emerging here. The weekly trend is in the process of flipping to down, right? We had this double top, and of course we've broken the neckline. And by breaking the neckline, we automatically bring in a lower low in the trend count. And the next thing we need to confirm a downtrend is a lower high. You can probably see where I'm going with this, but the upper wick of the developing weekly bar is a perfect retest rejection so far of the double top neckline. So could this act as the lower high off of a relevant structural level? To me, the answer is absolutely. You'll notice as of Wednesday's close, we're back down inside of the previous week's range. And I would say the most bearish development for Friday's close to finish out the weekly bar would be some sort of close underneath the weekly 50 SMA, which represents the bottom end of the do or die zone because it's also the previous structure from back here, right? We had previous resistance acting as support. Weekly 50 SMA is baked in there. A close below would be the nail in the coffin on the higher time frames, and I would be pretty convinced that an equal low test could be in store for the next couple of weeks. So the higher time frame chart is looking fairly concerning with the caveat that the weekly bar has not officially closed yet. So let's go on down to the daily time frame chart. Let's see what else we can learn here. What's the overall trend of the daily? It's still certainly down. We have highs. We have a soft lower high because we never really flipped into a firm hourly uptrend here. We never had any other hourly uptrends other than what's developed off of the lowest low in the trend count. So could the weekly lower high also be the daily lower high? To me, the answer is yes. Now, there has been a little bit of overshoot of the key level, which is the top end of the do or die zone. It was the daily 200 SMA, the green moving average on our screen, as well as the upper edge of the weekly expected move. But it's all within striking distance here. Now, because we do have a daily close on Monday and consolidation all day on Tuesday above the do or die zone high, I think it's worth acknowledging that stronger sellers didn't really step up at the ideal moment, at the ideal level, so to speak. So we're keeping an open mind that if this is going to ultimately be a trend reversal in the upward direction, if this is going to act as the low on the daily time frame chart, then the gap fill reversal to Friday's high of last week and holding the do or die zone low at 565.50, the weekly 50 SMA we were just looking at, as well as the structural element, that is paramount on the daily time frame chart to consider from here to here a higher low. Because just like this gap up constitutes a soft lower high in the trend count, we never really flipped into an hourly uptrend here. We never really flipped into an hourly downtrend here to confirm this as a higher low in the daily trend reversal perhaps. So for me, it's absolutely critical that if we're going to become bullish on this market, if this structural low is going to hold, we need to see respect. We need to see buyers stepping up at 565.50. If you take away anything from this video for the S&P 500, it's that 565.50 holds the key to the next move available in the market. Before we get on down to the hourly time frame chart, I do want to bring out the Fibonacci's from the highs to the lows and just call out that although there was some overshoot here, we're still well within the confines of bear flag consolidation in the grand scheme of this move. If we clear this up and drop it down to the hourly, what else can we learn about the possibility of a trend reversal here? The first thing to point out is that Monday's gap up is pretty impressive because what it does is it negates the hourly balance. This, all of last week basically, had neutralized the hourly trend. From here to here, yes, you had a higher low, but then you had an equal low. From here to here, yes, you had a higher high, but then you had an equal high. So the trend was neutral in this box, and if the gap faded in one session, day one fade to close the gap in its entirety, then the hourly trend would have remained neutral in this short segment right here as just a balance range. Now, that's not the case. So we need to give the buyers a little bit of credit where credit is due. And once again, we did see a daily close slightly above the 200 SMA on Monday and firmly above the 200 SMA on Tuesday. Now, the follow-through of Tuesday wasn't really all that strong. It was much more of a balance / distribution on the individual session. And as soon as the market broke back down underneath 573, the gates sort of opened up and we did see follow-through. Now, this is where we can start to get a little bit nitpicky with the analysis, right? In theory, if we had extremely strong buyers in the market, what would buyers have wanted to see out of this pullback? Ideally, you would have seen a move to test the top end of this balance range here. Buyers would have stepped up for a higher low at that level and then continued back towards the equal high here, potentially getting the follow through in the upward direction, which would of course equate to a daily trend reversal, right? It's not really what happened. We did get an end of day breakdown underneath 569.65, which is the top end of the previous balance range from back here. Let me zoom in on this a little bit better such that we're not squinting at the screen. There we go. So here it is, right? Buyers should have stepped up at this level, and they simply didn't. You can actually see in the last hourly bar of the session, there is an upper wick that starts to reject that 569.65. Now, I'm not saying that this is the end-all, be-all level. However, if early on in the session on Thursday, we open underneath, let's just say if the open is under 569.65, I would imagine that a very reasonable outcome into the Thursday session would just be looking to close the gap all the way into the Friday high and to test the do or die zone low, which we know holds a lot of importance based on the weekly analysis and the daily analysis. If we start to see buyers stepping up here, this is also a place where the hourly trend could preserve a potential higher low. Why is that the case? Or the daily even could, right? Because you have lows, you have a set of higher lows. This could still act as a higher low at the do or die zone low, 565.50. So I would be open-minded to this based on the strength that we saw from the buyers, or you could flip it. You could inverse the thinking and just say the lack of strength that we saw from the sellers to reject for a clean move underneath the do or die zone high, 573. The fact that we didn't see a straight up rejection there leaves us open-minded to this being a reasonable possibility. Now, this might sound like, oh my goodness, all of the time frames are at odds with one another. I can't decide what I'm going to do here. This is where I would remind you that your time frame of analysis must match your time frame of execution. If you're a swing trader, you probably want to be focused on what the weekly close looks like. If you're a day trader, you probably want to keep tabs on the hourly chart here and figure out what opportunities are available to us intraday. One of the things we've been very, very clear about, and I hope we've been very, very clear about in the pre-market preps, is that just because we've seen two daily closes over the do or die zone high, 573, did not mean that we were going to throw out the window all of our risk-reward trade location principles. Yes, we started to say, okay, maybe the bears don't have as strong of an edge as we thought, but where are we in the trend count? Does it make sense to long this at the highest high of the trend count? And to me, in the chat, we were sort of saying, right, all morning, no, does not make sense to chase this at the highest high. We can keep an open mind for a higher low pullback at either 569.65. We can keep an open mind for a higher low pullback on the gap fill reversal at the do or die zone low, 565.50. But it really didn't look like great trade location here. Another way to illustrate this is to use a classic trend channel, right? So I'm just going to come in from here, do something that looks like this, and that way, oops, maybe we can redraw as channel, hopefully. There we go. If I do something that looks like this, now if you connect your highs, sort of like we're playing with crayons now, you're at the upper range of the trend channel. Do you want to be long here, or do you want to be long here? I don't know about you, but it certainly makes more sense from a risk-reward perspective, trade location perspective, to be long closer to the bottom end of the trend channel, where there's support. So for those reasons, I'm highly interested in seeing and gauging what the reaction is from the market at 565.50 as to whether or not the daily chart will try to offer a higher low, or if we blow right through that, by all means, this is likely the outcome I will be aiming for. If we're underneath 565.50, looking for downside, looking for the equal lows here, looking for a move into this, looking for a move into the equal lows here, and then lower lows on the weekly chart over time. Not immediately, not in the blink of an eye, but that's where the bears really build back their edge, in my opinion. A lack of hold at the 565.50 level, the do or die zone low, holds the key into the end of the week. And yes, the timeframes are slightly at odds. And what will we say about that? Of course, as trend traders, we make the best of the market and the circumstances that are available to us when the trend has firmly been established in one particular direction. It's typically very choppy and very difficult to execute a trend-following system when the market looks something like this. Notice that although it's not as clean, we are dealing with a balance and maybe just the very beginning stages of a balance here. It could easily be classified as look above and fail, and I would confirm the look above and fail if we were to see price acceptance underneath 565.50. I've been ranting about that level nonstop all through today's episode. Hopefully that's resonating. Hopefully you can see the logic as to why that level is so important, and if it fails, then there's nothing more than trend continuation from the top-down perspective. Weekly trend sets a lower high, daily trend sets a lower high, rejects the upper edge of the weekly expected move, daily 200 SMA, and then the hourly fails its uptrend by being underneath the trend channel with a lower high here at 565.50. I think it's clear. We know what the top watch is into the end of the week. Let's get into some supporting evidence here that will help us understand whether or not, actually, before we get to supporting evidence outside of the S&P, let me also just show you the intraday anchored VWAPs. If I do something that looks like that, the anchored VWAP from the lowest low of the move is where? It's right at the do or die zone low, 565.50. So if there was ever a key level to watch on the charts into the end of the week, that is it. You can see the top end of the anchored VWAP cluster is the local high set here. You get back up there, and I do think we have to keep that open mind to a more bullish trend reversal, and we'll take that in stride when and if it happens. You would need to see this, some sort of reversal, back up to the equal high, right? So being open-minded to the inverted head and shoulders here, possibility for a double bottom here, maybe the neckline even just becomes this area at 569.65. From here, a trade opportunity might look something like this. It's all about trade location and being very, very strict with yourself as a trader, trying to spot the best location that gives you some sort of tight stop relative to the reward that's available amidst a trend change, right? That's where I'll leave it on the spiders. On the intraday action, let's take a look at some supporting evidence, firstly starting with the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? The volume flows on the Monday gap and go were substantial. They did hit positive 300 million. That's to be expected when you get a gap and go. Why? Because you're completely outside of the previous day's range. You're well above the previous day's settlement, and this measures from the previous day's close. So not a shocker there. Tuesday, very sideways session, very sideways internals here. Very sideways internals here. A little bit of a bearish edge into the close, pretty flat on the Monday tick, which I think we can read into just a little bit and say that this to me really looks like short squeeze on the Monday session, not so much new money buyers. Why would that have been short squeeze? Well, think about why the pre-market session gapped up in the first place, right? It was a tariff headline. Is that dramatically going to shift the participants overnight and get involved new money buyers? Or are those old money shorts who are maybe closing out through the pre-market session and not really looking to sort of get out of their shorts and stay neutral for a second? To me, it's a little bit more reflective of what the internals suggest, primarily based on the tick here. If at the exchange level it was just buy everything on the Monday session, I would have imagined a stronger positive build on the Monday cumulative, and we just simply didn't get that. So that's a small feather in the cap for the bears as well. If we're thinking about today's Wednesday breakdown, let's just get a sense for our stronger sellers stepping back up. From a volume point of view, the answer was actually no. We did not breach negative 300 million. However, we went from positive to negative on the advanced decline line with a strong index score all day, intraday, for the sellers to remain in control, right? We were in that sweet spot where we have this little outline there underneath negative 15 to negative 20. The cumulative build speaks for itself. This is a straight 45-degree line build, which means this is not a liquidation break. This is more methodical selling and not so much capitulation. This to me does appear like stronger selling. Why? Because capitulation would look, oh my goodness, off of the open things are terrible, and then they get better into the close. Almost like what happened on Monday. Short squeeze, right? Typically looks like that, where you neutralize after a pretty intense move off the open. Look at the open up here on Monday. Very, very extreme. So the fact that we just built all day out of the cumulative, instead of just opening on some extreme and then fading weaker into the settlement, that is more indicative of stronger sellers, in my opinion. So as you can start to sense how I'm putting the pieces of the puzzle together, I personally, and this is, I'll tell you when I'm just reading the data points versus giving you my personal opinion. This is opinion. My personal opinion is such that the higher time frames really have not changed their trend. That's the weekly, that's the daily. The internals here probably support stronger sellers being involved in the market, and the gap and go from Monday really being more of a short squeeze as opposed to new money buyers getting involved. Let's take it one step further, though, and let's take a look at the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. And what we want to focus on is the, first of all, Monday session. Not only its shape, it's a P-shaped profile. So that means that A period offers a P post, which is always indicative. P-shaped profile is short squeeze. But notice the M period spike into the end of the session. So a little bit of excess there on the Monday high in M period. And if we just do something that looks like this, notice that on the Tuesday session, we opened above the base of the spike. We hardly, it was not really a gap up. It was right at the prior day's high, basically. But in theory, what does this mean? Well, it means that the spike and spike rules suggest that the auction should continue in the upward direction. Well, look at where the value area and the point of control closed from the Tuesday session, underneath the base of the spike. So as I'm thinking about this through the perspective of, okay, do we have new money buyers entering the market, establishing positions? No, that should have been over the base of the spike if that were the case, and there was going to be firm follow through in the upward direction, posing some sort of threat to like a lockout rally for higher. If we look at today's value area and point of control, I mean, it really speaks for itself. The value, if we just, let's start this way and maybe extend to the left, the value is almost completely, just by a hair here, almost completely underneath the value from the Monday session, which is telling from the bear side. That means that anybody who's short from up here is feeling, of course, happy. And even if you reverse the roles and say, no, I'm totally convinced these were new money buyers. If that's the case, how do longs from this position up here feel? Well, they probably feel like this, which means what? They're more likely to close out their positions if they haven't done so already. Note also that we have a poor low from today's session, K and L period, so the auction did not end properly at the bottom end of the move there. If it needs repair, we should be expecting lower, which aligns with, at minimum, looking for the gap to close to Friday's high of last week, right? That would be at 57.25 in the ES futures. You do have a subtle E single print period right here for a delineation of upper distribution, lower distribution. Very simple way to watch this into the end of the week is, where do we close? Do we close in or above distribution 1, the top side, or in or below distribution number 2? And you'll have your answer. A stronger market here would rally immediately into distribution number 1 and get acceptance up here. It would find acceptance back inside of this value. A weaker market probably just spends all of its time in or underneath distribution number 2, and you could sort of use these E-period single prints and just half back of today's session at 57.88 roughly to delineate your over or under. Okay, so that's some nuance from market profile. Let's get back on over to the platform here. Let's fire up our good friend, the QQQ, and see what's happening from a NASDAQ point of view. We'll go to the weekly chart just to be congruent in the analysis and make sure that we're not missing any big data points here, but lo and behold, it's mostly the same. This is actually even worse with the weekly developing bar. The upper wick's not even a full test of the neckline yet. That's just bearish. It's inherently a lower high underneath key structure. You could even extend that off to the left further and say that you're under this previous breakout point as well. Resistance, then acted as support, We're underneath. This is bearish. We're inside the previous week's range already as of Wednesday's close. And as of Wednesday's close, we're also underneath the weekly 50 SMA. Doesn't really look like rainbows and butterflies to me on the buy side, trying to find a stronger bottom. Let's go back down to the daily time frame chart. Let's try to do it this way as to not have to totally reset the charts. There we go. And what do we see? Instead of closing on Monday and Tuesday over the daily 200 SMA, we were underneath the daily 200 SMA this entire time. I would say that the key level we've been using, and we didn't really so much have a zone out of the QQQ, the NASDAQ side of things, but this low from in here, these previous lows, I should say, and this rejection before the drop-off, the most recent lower low push, was at 492.50, in exact sort of confluence with the upper edge of the weekly expected move, daily 200 SMA. There was no breach of that level, and we've talked about this in the pre-market preps, just to point out that the NASDAQ is the place of weakness right now, and I would still be thinking about a full gap close, but this is still totally just a lower high. It never really found any acceptance over the key level. So therefore, I would be even more pessimistic on the NASDAQ than I would be about the S&P 500. The S&P at least has different sectors, right? Financials primarily, a little bit of healthcare weight there, some consumer staples as well, but it has much more of an opportunity to rotate versus your QQQ NASDAQ 100, which is mostly concentrated in tech, of course. There's nowhere to hide. There's nowhere to rotate if tech's going to get beat up here on a secondary leg lower, this being the primary, a secondary leg lower in the broad market as a whole. So the fact that we're rejecting this key level out of the NASDAQ leads me to believe that there is still some underlying weakness in this relative to the S&P. So with that understanding, of course, any sort of gap close is going to be still critical here, and we've still labeled it as do or die. It's at 480.25. I would go one step further, though, because, excuse me, of the way on the hourly chart, and just, again, to be congruent with the spiders analysis, let's just come from the all-time high to here, just pointing out that we're still underneath the fib 38.2. We're all on the same page there, all set. But if we zoom in on this action a little bit further, what I would like to point out here is this balance range is a little bit cleaner, and these highs should have been respected better, and they're sort of in process of being respected right now, than the S&P. The S&P is clearly underneath, the NASDAQ is slightly above, but I think it really leaves an opportunity, more so, for a downside trade to emerge. How does that play? Well, any rally off of this that sets a lower high here, then looks for the equal low breakdown into the range, will give some respect to the do or die zone, but ultimately, if this is the balance, look above, and it's not really a failure because the target has been hit. You could think of this as a bearish data point too. If you're breaking out of a range, you always look for a range double. When you hit the range double, target complete, measured move complete. Measured move complete, right? So if you're going to rotate back into the lower range, you're probably looking for what? These equal lows down here at 473.25. So there's two ways to trade that out of the QQQ, right? You're pessimistic because we never really got much acceptance at all over its key level up here, 492.50. Therefore, we're seeking a lower high to change the hourly trend because we have lows, big shelf of higher lows, possible higher low. We have highs. We have two equal highs here, which are higher, and we have a higher high up here. If we set the lower high, great. Equal low breakdown brings you to at least here. Risk, reward is one idea. Then you're ballooning runners into the bottom end of the range from back over here. That's an equal low on the hourly, 473.25. We've got all these helper levels on the screen, right? So I'm going to take this one step at a time out of the NASDAQ, but with the primary idea that this is actually weaker than the S&P underneath and never really getting much acceptance over that 492.50. If this is going to reverse in the upward direction, I would be thinking about something along these lines, maybe producing an inverted head and shoulders. If we can get a higher low back over 484, I would trade it. So if it's down first and then up, a higher low here gives risk reward that looks like this, thin structure retracement to the upside. Then I would reevaluate. Does this roll back over to ultimately go back down, set a lower high, make the equal low, balloon runners into the bottom of the range at 473.25. So those are my primary ideas for the NASDAQ to end out the week. I think the S&P is at a little bit more of a critical juncture based on what we've described already. If there's a huge rally to the upside that gets consolidation here, we'll concede the point that an equal high breakout, a Brigade bolt here, will unlock some upside. And that's probably a story for next week at this point, if that's going to take shape, right? This would act as the next hourly high or low in the trend count. Let's quickly come in with the intraday anchored VWAP, see what we're dealing with here. I think this just reinforces that the lowest of the anchored VWAPs is still confluence with that 480.25. It's a key level we're mindful of. And we didn't really talk much about it on the S&P side, but we are under in both indexes the anchored VWAP from the Monday gap up. So that's a great spot for that lower high, offering a decent amount of confluence, giving confidence for this lower high being a reasonable trade thesis to pursue. Okay, that's my take here out of the QQQ. Let's drop it on down to the NASDAQ internals. We will see we had strong volume inflows on the Monday session for all the same reasons as the S&P 500. Decent volume outflows today. We were in trend higher zone, closed slightly underneath, got to trend lower zone. Instead of opening in positive territory, closing in negative, we opened at zero, closed in trend lower zone for the advanced decline line on the NASDAQ. And the cumulative build is the same exact story. I won't rehash the same analysis there, but it looks more to me like a little bit of short squeeze on Monday and more so new money methodical sellers on today's session. Very organized downtrend. That's one thing we could say about this for sure. A very, very organized downtrend. Push, pull, push, pull, push, pull the whole way down. Organized downtrend. That's really indicative of sellers stepping up. Not capitulation, emotional style like, oh, a flash crash, but just stronger sellers sitting on the offer saying, hey, sell, 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 right? And to me, that is not helping the bull case for the broad market as a whole. Let's quickly check in on the market profile for the NASDAQ side of things here. Let's give this a little auto zoom. There we go. Same commentary, same conversation. You can see that here's value area, here is value area, not really progressing too far. Didn't have as much of a spike. I guess maybe a little bit better, but still underneath that daily 200 SMA. Poor high, you want to carry that forward. If we do end up with the situation, if we just go back here, if we end up with the situation where this is in play, I would definitely carry this poor high forward and say, if we go through that, I would expect a breakout, right? First impulse of a poor high is to always back away. Second impulse on the retest is to go through and break it to properly end the auction. This is incomplete. We can see A period single prints through this liquidation off of the open, but then pretty methodical drawing out the profile. It's not a pure like single prints all the way to here and just a little B shape at the bottom. So I wouldn't call it long liquidation. It would really require a much longer A period post. Like if this didn't exist, then maybe, but we're not there yet. Value is certainly lower. Point of control is lower, completely underneath value from the Monday session. Rinse and repeat of the S&P analysis. No poor low on the NQ. However, if we zoom in here, I just want to check. We probably have a lack of material excess. 2 TPOs really aren't enough these days to consider something material excess, so I would still consider this a weak-ish level down at the bottom of the NASDAQ, meaning it could be repaired and we should be thinking about follow through to the downside if we're underneath. Let's go back on over to the platform. Let's finish up our broad market indices. Let's take a look at the IWM. What's going on? Quick weekly check. Developing weekly bar is well underneath all of this overhead supply. We know that we've been tracking this not as a double top, but rather a head and shoulders, neckline being here, neckline being here. Use a trend line, doesn't matter. Well underneath for a potential lower high inside the previous week's range. Almost a rinse and repeat, but even more bearish being underneath the opening print of the previous weekly structure, right? So it looks like a lower high in the overall trend count. Let's go to a daily time frame chart here. Let's have a look-see. The better argument to be made is that this, as a inverted head and shoulders, could emerge as long as the market holds 204. Now, is it going to change things dramatically? From the weekly point of view, not really, but for the daily, like a trend has to start somewhere, right? And they always start on the smaller time frames, just FYI, in case anyone was confused about that. Trends always start from the smallest time frame and ripple their way out higher. If we're over 204, it's a potential daily high or low. And of course, the inverted head and shoulders would suggest that bringing in a firmer higher high over 209.25 means that we have to change our tone to a daily uptrend. I don't like it, but that is the reality of the daily uptrend. That is the reality of the situation we're dealing with. Now, is it still possible that a weekly lower high could be found here? Say weekly lower high? Absolutely. That is absolutely the case. So the butting of the heads of the time frames is one of these times where, once again, I'll reinforce the idea you need to be mindful of your trade location as a trend trader, and you also just need to sort of juggle that mentally and remember that your time frame of analysis must match your time frame of execution. If you're a short scalper, if you're someone who's like, I'm only in there for a couple of minutes and a couple hours, whatever, then you might note that it's possible a weekly lower high develops here, and you might carry that forward as a strong level, and you could watch for a short setup off of that, but boy, oh boy, you should be willing to take a long here as well to get back into it, as long as the trade location and the risk reward makes sense in accordance to your time frame of execution, right? Time frame of analysis must match time frame of execution. We spent too much time on this here today. Let's move along. Let's speed this up perhaps to the second half of the video. I always say it, but let's make a point to do it today. 204, key watch, key hold. Let's keep it simple. Inverted head and shoulders down here, go. If this is a double bottom, that's a go. Watching for buyers to step up. Obviously, a Brigade bolt underneath. I would love to see this as bearish pressure for the broad market in its entirety, S&P and NASDAQ. Not so much NASDAQ, but really S&P underneath 204.40. Show me the money here. That's a Brigade bolt short all day long, and it really opens up through the thin structure under the 202.40, right? Lower edge of the weekly expected move, bottom end of this balance range would be the target 198. Let's quickly check in on the intraday anchored VWAPs. Lo and behold, there's your 204. All the anchored VWAPs right at our key levels. Again, for the sake of consistency, let's come in from the major drop down to the low. Where are we? Fib 38.2. All of this is technically nothing more than a bear flag in the context of a weekly, daily downtrend. Hourly uptrend, yes. Break the trend line, though. Sayonara. Looking for the equal low, right? You call that filling up the triangle. Filling up the triangle is the classic term on that one. Here's your trend line. You're looking for a break to close the 90-degree triangle. There we go. Let's go back to geometry class, back in high school, right? Okay, in the spirit of speeding up, Quick check-in on the market internals for the Russell side of things. Strong volume inflows, same analysis as the other components of the broad market we've looked at. The only anomaly here is the stronger cumulative build to the downside on Tuesday, which was much more flat on the ES, right? So still bearish here at the exchange level, and I think this is more indicative of the short squeeze and just the nature of gapping up, well disjointed from the previous day's settlement. Let's get on over to the market profile for the Rusty, and we'll see what's happening from this point of view. Tuesday's value was not even overlapping to up with this. It was overlapping to down, as a matter of fact. There's great excess on the highs and lows of recent profiles other than today's session out of the Rusty. Notice that the point of control value area is completely underneath all of the value from the Monday and Tuesday session. To me, that is a bearish takeaway, signaling that either longs are trapped from up here or sellers are feeling a-okay. They're feeling good and confident about their positions. Let's get back over to the platform. Let's take a look at the weekly performance of the S&P sectors and see what's going on from this point of view. Who was leading, who was losing, and where was the weight? We have discretionary leading, which is actually a heavier weight risk-on style sector. Then we have energy, then we have staples, then we have financials. Financials also the second heaviest weight risk-on sector. The bottom end of the barrel is semiconductors, though, not helping NVIDIA's big move to the downside today. The technology sector down 1.69%, then utilities, which is a more defensive sector. So when I say that the NASDAQ looks more susceptible to downside because it lacks rotation, this is exactly what I mean. Notice that we have energy, consumer staples, and financials, right? There really aren't any financials in the NASDAQ. That's helping the case for the S&P to remain a little bit more resilient. Whereas if you look at where the weak spots are in the market right now, it's just tech and tech, right? So that's something I would certainly consider. Let's take a look through these structural charts and see what's happening from this point of view. A couple of updates here with the levels. I've adjusted this level here to reflect the gap low, as well as this previous low, drop-off level, possible pullback happening here. If this just sets a lower high, then it's a lower high. This is really the thesis and the argument from the weekend video on Saturday, which is just that lower highs can exist across the board, and we will not have any immediate trend changes in the sectors. XLY playing nicely so far, lower high available here at 205.75. Moving along to energy. The sine wave continues. It's made its full rotation back to the top end of the range. We'll see if it rejects. It does have a pretty looking inverted hammer there back to back with the Tuesday session as well. Let's move along to the XLP and see what's going on with consumer staples. Midpoint of its range, off of its low, possibility for a lower high, absolutely tangled at the moving averages. Yes. 80. If it rejects here, looking for the equal low, trading into this gap, that of course is bearish pressure. Even if it does accept over the level, D for defensive, it should not be the sector to lead a recovery in the S&P 500. I would still be thinking about a bearish market if the XLP is getting this consolidation here. Moving along to the XLF, what's going on with financials? Pretty do or die spot. Inverted hammer, outside bar on today's session, rejecting potentially this overhead supply. Rejection of 50.70 gets really interesting for two things. Firstly, a lower high from the all-time high, but then secondly, if this pulls back and catches for a higher low here, that complicates the issue in the S&P, and once again, it allows this to remain a little bit more resilient than the QQQ NASDAQ 100, Right, so financials, top watch here on the interplay between 50.70 and 49.60. Moving along to materials. Look at the acceptance underneath here. It's the lightest weight sector we have, so it's not going to make all be all, end all be all, but it does strike me as being slightly more bearish, still inside of this consolidation, not attempting to make higher highs. Moving along to XLC. It has broken out. It is over a key level. This is like do or die instantly on the open for Thursday. If price can remain over 99.15, great. We'll continue to look for the counter trend closer to 102.70. That would be a bullish data point for the S&P. If we fall underneath, lower high, rejecting the 50 SMA, I would look for full range rotation. And then what are we dealing with? At that point, come on. Pattern traders, where are you? Right? Show me the head and shoulders. Show me the move underneath the neckline. Sayonara. This looks like distribution, a breakdown here. We're probably talking about more of a bear market in the S&P 500, not just a 10% correction. So watching that out of communications. Industrials, not much to comment on here. Really more interested in swing highs, swing lows. There's a pretty clean trend line that just catches my eye, something that looks like that. You could read into it. As long as price is over 131.45, I would be open-minded to this as inverted head and shoulders. You would need price acceptance, though, over 134. It's not really hurting or helping the case for the S&P as of right now, considering its weight. Real estate, same bucket, not helping or hurting. Semiconductors, absolutely hurting. Reason being is if this is inverted head and shoulders. You probably didn't want to go back down to the right shoulder after getting some attempts on the gap up near the neckline. You really would have wanted to see that follow through into 237, straight shot lower today. And this primarily comes on the headline, right? That the US blacklisted 50 companies from China involved in AI. So what does that mean? Of course, it's going to be much harder for NVIDIA to sell their chips in an international sort of scope, right? So that's perhaps one of the catalysts if you're one of those people that needs to put like the logic behind why something maybe happened. If you need something to explain it, that could be a reason. Obviously, it pressured NVIDIA substantially lower today. We're down about 4.19% in NVIDIA as measured from the open. So this is not really a compelling look. You'll notice that the volume clearly upticked on today's session. Not that I'm a huge proponent of volume as being the end-all be-all, but it certainly seems as though there's more of a panic there instead of like, just a little malaise, nobody's really selling, and then it'll snap back hard, right? So that's my take. And it did not capitulate to a new lower low. So it's not like, big sell-off and it's got to rebound and produce, this nasty, snap back, dead cat bounce. No, we've just rotated from the top to the bottom of a range. I think the door is open for potential downside into the equal low at 211. Let's move along to the XLK. Same concept happening here, where this just looks like a clean lower high that's being offered underneath the overhead range. Really not much to say that's bullish here. A better bullish chart would have accepted over these two equal highs, continuing the counter trend, and it just simply did not take place. Utilities, nothing to comment on, sideways in the range. Lightweight sector, we're moving on. XLV, healthcare, I want to see it. If it's going to happen, show me the money. Show me the breakdown underneath the neckline. This is a D for defensive sector, but it is the fourth heaviest weight sector. If this takes place, it's probably going to act as a headwind for the S&P. Only if the semiconductors, if the tech sector does not catch a little bit of a bid. If there's a rotation, then maybe the S&P can withstand that. But for now, this does strike me as a bearish look on the chart, rejecting the 200, rejecting the 50. Lower high has been set, so on and so forth. The pattern stands. TLT, let's take a quick look, breaking down through this area of previous resistance, back here support, over here support. Not really completing the major inverted head and shoulders. This minor inverted head and shoulders is already gone. We know that. So watching this closely, but rates really are a separate conversation, in my opinion, given what we just got with the FOMC and sort of the PCE that's coming out on Friday. So we'll talk about that momentarily. But for now, let's continue along with our sectors and just the dynamic of risk on, risk off. This chart does not really look like it had done anything impressive during the counter trend gap up on Monday. So what I want you to do is reset the context in your head to Monday was a huge gap up, right, in the S&P 500. I know we just finished the small caps, the NASDAQ, but let's think S&P 500 here for a second. Big gap up, two daily closes Monday and Tuesday over the daily 200 SMA, over the 573 level. Did this do anything impressive? The answer is no. It just looks like sideways consolidation in a downtrend that's weak, that is risk off. Did the XLY do anything impressive? It's got a counter trend move that's developing, but still seems like a big opportunity for a lower high underneath the daily 50 SMA in gold. Financials look great. This honestly looks pretty solid with a move back up to the equal high here. I would honestly say that this does start to suggest more of that rotation aspect, which we sort of acknowledged on the structural chart as well. If financials pull back for that higher low and continue higher, it's going to keep the S&P slightly more resilient. So I'll give a check mark there. But so far we are 1 for 3 on the bull side, 2 for 3 on the bear side. What about healthcare? A little bit more neutral. It's underneath these lows. Certainly a lower high is possible there, but it's over an upward sloping 50 SMA. It's a D for defensive sector. Let's go neutral here. Let's take a look at the risk off sectors, XLP, XLU. What's happening? Is this possibly a high or low over the 50 SMA? I would say yes. So although I'm putting a check mark here, technically it is risk off. Same thing happening here in utilities. What about the specialized ratios out in this dashboard here? Looks like a lower high, that's risk off. Looks like a lower high, that's risk off, risk off, risk off, and risk off happening over here as well in the ARKK. Speaking of risk on, risk off, let's go to the TLT ratio to the S&P. A little bit of a pullback here, however. Extreme move off the lows relative to this persistent downtrend we had seen prior. Is it possible that this is digesting some of the relative strength gains? It is possible. I would say that obviously this week with the move lower here, bonds have certainly underperformed the S&P, so it doesn't look like a full-blown flight to safety. But the market's also not pulling back hard. It's not like there's a reason for money to rotate out of equities and into bonds as of right now. So I'm a little bit mixed on this data point. I don't really think that it suggests an overly bullish environment out there. You can even see that bonds technically outperformed today. Let me zoom in on this real close. Small uptick on the ratio, just meaning that bonds were down less. than the S&P 500 equities, right? So you're getting that a little bit. And I would say if there's follow through to the downside, this is where that data point would become much more meaningful. Let's move on over to some currency here. Currency, now let's go rates first. Rates are pretty much unchanged here. They've been this way for a little while. On the week, yeah, they gapped up a little on the Monday session with the TLT gapping down as we saw, but generally still inside of this. My big thesis here, and it's been the same for a while now, is that the market got ahead of itself way out in front of its skis, pricing in some of those recession and growth concerns. Rates came down aggressively, and now that Jerome Powell has basically said, we're uncertain too, the market's just going sideways, waiting for that next shoe to drop and the next big information tidbit. Let's take a look at some currency now. Let's go Dixie. Small uptick here, which makes sense relative to what interest rates have sort of done there. Small uptick towards the top of their range. Let's go gold. A little bit more of a flight to safety on the recovery back to the upside here. Notice that gold is much more sideways. This is a daily time frame chart versus the S&P, which came in hard on today's session. So this uptick here does strike me as still a little bit more defensive posture as compared to risk on, let's go full bore equities. It's just, the path is clear. Oh, we should have total exposure, right? Not really there yet on the gold scale. Let's come into the inverted ZT to get a sense for what the Fed tracker tool should be doing. No big changes over here, so let's not expect major changes out of the Fed tracker tool. Do we even have that pulled up? Yes, we do. It's over here. We have 425, 450 as the forecast still for May, which makes total sense. We're pricing in 1, 2, and no longer 3. No longer 3 rate cuts for 2025, just 2, and then 1 as soon as we open up 2026. We'll continue to keep tabs on this. Again, less of a priority right now until we start getting more economic information, which we are scheduled to get. Before we talk about what's coming up on Friday, I do want to call out that the services PMI saw a pretty severe snapback on the Monday session. And remember that this is one of the data points that firstly caused the growth concerns. If we take a look at the previous PMI, it was sort of falling off of a cliff. The trend here was aggressively down out of services PMI. And we know that the US economy has a lot of its contributions come from services. So the fact that this was on such an aggressive downtrend trajectory was concerning. That it came to an end, maybe not fully an end, but that there was some relief out of the services PMI was very notable on the Monday session and actually helped fuel some of the push to the upside, not just the tariff news over the weekend, which caused the gap up. The next thing we could talk about here is what happened on, I guess durable goods is fine to just look at in this window. We actually beat the expectations, meaning that there is still consumer spend out there. That's another positive indication for the economic growth story. If we take a look at what's on tap for the remainder of this week, our typical jobless claims tomorrow morning, 8:30, will be live up in the Penthouse office, of course. We have final GDP, so speaking of growth and what's happening there, 8:30, so this is baked in at the same exact time. Just understand that the market's probably going to have a reaction. I would, depending on what happens with the market actually and what these data points look like, we'll have to decipher that in real time. I'd say if we have a big miss out of jobless claims, I would expect the market to panic. If we have a stable jobs market and GDP is a slight miss from what we have here, I think we're okay based on the PMI report that we just got earlier on in the week. This may not have totally encapsulated that data point, right? Scrolling down to the Friday session, we have PCE. PCE is a reflection, basically. The market's gotten pretty accurate in terms of pricing in what we see in the CPI and the PPI, consumer and producer side, to reflect a PCE forecast. But the only concern I have here, and we talked about this a little bit in some of the pre-market preps, we were digging around on both Polymarket and Clashy. If you take a look at the Clashy market here, what we're pointing out is that the forecast from the betting market is actually 0.4. And we will come in slightly hotter than the expectation. Now, keep in mind that the headline number is always a rounded figure. So this could come in at, 0.351, and we round that up to a 0.4. It really falls in between. So we'll watch to see what the exact number is, but regardless, watching the headline there, the betting markets are saying a hot read. I would say based on the previous CPI and PPI prints, I wouldn't be surprised to see the expectation here at a 0.3 if I'm being quite honest. Consumer sentiment revisions are less important than the preliminaries, so we're all set on that. If we take a look at the earnings calendar, Lulu is the last big one to watch here. Thursday after the close. You can keep your eyes peeled for it. Let's get back on over to the platform. Let's finish up our interrogation. Let's jump on over to bonds relative to themselves. Small uptrends are starting to build here, but still underneath 50 SMAs in 2 of the 3. You've got one in the longer end of the curve that's starting to get a little bit over the 50, but still it's just reflective that the longer end of the curve is still doing a majority of the lifting for the Fed with that uncertainty. The market has basically brought rates down with the expectation that the Fed's going to panic, not so much that the Fed has laid out their hand yet, which is why the shorter end of the curve is not getting as much love, right? Let's take a look at, let's jump on over to credit spreads, popping back in the upward direction, especially on today's breakdown. I think that's noteworthy. I think that these are clear opportunities for higher lows to persist in uptrends that are developing. This would be a bearish data point. Remember that bulls wanted to see this come right back down to the floor. Doesn't look like that's happening. So that's a slightly more bearish takeaway. HYG in isolation, big breakdown relative to this and this. Look at this and this. So this is divergent to the downside with the S&P 500. Notice that this is much more of a it's a lesser higher high, or you could even make the argument it's an equal high versus this is a higher high in equities. So junk bonds are saying, no, slow your roll. Not looking like a breakout is imminent here, and a trend reversal is underway in equities. So keep that in mind as a bearish data point as well. What about Bitcoin as a proxy for risk on, risk off? The Sailor shift tool is getting close to the zero line, but it has not punctured up and through. So we do not have a positive indication there. And we're still getting overhead supply with the possibility of a lower high here at 92,000. So carrying that forward as a risk off, let's say risk off indication here out of Bitcoin so far. Moving along to breadth, I'm digging deep for everybody who's like, oh, it's got to be a bullish trend reversal. Small improvements in breadth, but where are we relative to 50% underneath? Where are we in new highs versus lows? Small improvement, but still technically underneath the zero line. We are not seeing expansion of breadth in the upward direction as this rebound rally has taken place. It's hard to get bullish in an environment that looks like that. Like I said, I'll tell you when it's my opinion. I told you my opinion is that probably seeking some sort of downside here. I don't want to be overly biased to the downside, but that's just sort of what the data points to me suggest. Let's go RSP. Inside this range, I would say the nail in the coffin is a breakdown of 174 RSP. You could set an alert there if you want to help her. QQQE, same concept at 89.20. Then we could start taking a look at volatility. Small uptick out of vol today, but still underneath the 2050 floor or ceiling, perhaps, depending on how you look at it. But remember that we want to take a more complicated, or it's not complicated, it's a more well-rounded, maybe complex. Remember, complex and complicated don't have to be the same thing. There's many parts of a complex system, but it doesn't have to be complicated to understand. So we'll call this complex analysis, but it's not complicated. VVIX, volatility of volatility, small uptick here. What do we really care about? Let's go to the main dashboard here. This is it. And as of today's close, we actually have an inversion of the front. There it is, a little tick again. An inversion of the volatility futures curve. And we can even go over here. I know that we've been using this one a little bit more so than the custom study recently. But if we go here, this is what's ultimately flip-flopping back and forth. I don't know if this adjusts in real time to the post-market changes. But ultimately what we're seeing there is that the difference, right? You're talking about a 20-cent difference versus a 15-cent difference between these three. If you take the April to May versus the May to June. And what we're plotting basically is that, yes, we're over the zero line. We're in contango technically. However, the inversion, let me zoom in on this, is such that this spread between the two is less than the spread we have there. So the curve is flattening, right? The front of the curve is a bit flatter than what we'd like to see and is more likely to invert, go back into backwardation basically, on any signs of further volatility. The other big one that we like is the one-day VIX, right? Because all of the order flow, basically, for anybody who wants a quick volatility rundown, all of the volatility in VIX itself really keys off of 30-day SPX options. So you can, VIX itself is keying off of stuff way out here in the 30-day range, which is fine, but take a look at the volume that's transacting out here. Open interest is like hardly anything on the call and put side. Not much there. Hundreds of contracts, tens of contracts. Go to the one day, and now we're dealing with at least thousands of contracts, and this will, of course, open up to become much better. You could take a look at this, of course, expired today. This is today's series. On the put side, all of this volume that's going through. So the one-day VIX is really what we care about. Big spike right back up to its ceiling. This is where the danger zone is. So I don't think we're out of the woods from a volatility perspective is the gist of our complex but not complicated view of volatility. Let's finish up the analysis here. We've talked quite a bit today about all of these moving parts. I think it's time to bring it home with a couple of ideas through the core list of companies and then 4 additional. NVIDIA breaking down underneath its lows of the balance range here. To me, this is a lower high. You have lower high, lower high, lower high. You're underneath the next key level at 114. Brigade bolts open the door. You're looking for the equal low at 104.75. Hourly charts next. What do we see here? Let's zoom in on that a little bit more appropriately. Could this be a double top? Sure. Show me the love underneath the level and then show me the follow through back down to this low. One thing that we will say is if there is going to be look below and fail, you could take this trade. You probably want a little bit of a helper level right here around 115.25. 115.25 would be your helper. And you would say, okay, this gets me a little bit bullish. I probably want to execute through the thin structure retracement if it's look below and fail on this higher low here. Risk, reward to the upside. But more favorable is consolidation underneath, aligns with the daily trend that we were just looking at for downside, right? That's NVIDIA. Moving along to Softy. Let's go back to a daily. All of the overhead supply is still there. This is a rejection back inside of this previous range. The consolidation looked okay. No follow through up and over the 2 equal highs. Closing back in the range means what? Look above and fail. On the hourly chart, here's your range. Here's a look above and fail. Lower highs under 392. Looking for follow through towards the bottom end. Firstly, respect this level 385.50 and then 382.25. If the market does do something like this, I would be patient, very patient. I would not be fishing for longs in this range. I would say, show me the money, show me the higher low over 395.50. Let's move along to Apple. Apple weekly, daily lower high, I think is totally imminent here. You have highs, lower highs, lower highs. This zone in its entirety can act as the lower high. Upper wick rejecting that today. Let's take a look now at the hourly with that context. I would say that you're really just, or I'll speak for myself, I'm looking for something like this. Show me this. And that's a possible setup that I'd be interested in underneath the neckline at 219, right? So there's that. If I'm going to be bullish on Apple, I really don't. I don't like Apple bullish just because of the daily posture of what's happening here. This is the lowest low in the trend count. This is still just a counter trend move underneath the key moving averages, underneath the previous area of support that's now acting as resistance. I do not like it on the long side. I would need to see something that looks like this to change the structure. Next up, Amazon. Speaking of a structure change, this is sort of do or die at the top end of the range. We do not want to see a full gap close out of Amazon. We just want to see support if we're looking for longs over $200.25. Let's take a look. Here it is on the hourly, right? If this is technically going to be a successful breakout, it should hold here. It should hook back to the equal high and get follow through. Amazon's structure is better than some of the other things we've seen so far. A better push away from the daily 200, a better clearance of the balance range here. If this can hold as a higher low, this is where I would look for longs. If the asterisk here, the broad market displays relative strength. If the broad market's bullish, I would say Amazon should be a top watch for all these reasons that we've just outlined. Risk, reward, back up to the equal high, right? That's that. If it falls into range, yeah, I mean, I suppose maybe we shouldn't write it off as a non-bearish setup just because there's a gap structure underneath. You could go thin structure retracement under $200.25, closes 196. Let's move along to Google. Google is a big failure of the inverted head and shoulders here. No Brigade bolt over the neckline. And now, of course, we're looking for the inverse. Brigade bolt underneath the neckline confirms 166.35 as resistance. This is a daily, weekly lower high. Looking for the range rotation, bottom of the range. 161.50 becomes the target. Where would I long this? Have to be a higher low over not just 166.35, but 167.75. You would have to get back above that level to convince me that we want to long for risk reward along these lines here. Next up, we've got the metaverse. This one remains bearish, and we sort of went through this mental exercise in the pre-market prep this morning. The reason we remained bearish on this, and you should know this stuff like the back of your hand, even if we're on the hourly chart zoomed in like this, you should know in the back of your head that 635.25 is the weekly daily level from back here. So the fact that this rejection is coming in off of that structure, to me, remains more bearish. Doesn't matter that we're over the top end of this. This is a major level. This is a huge failed breakout. Lower high underneath, sayonara. Probably looking for an equal low to the daily 200. And to get there, how do we participate on the hourly? This is, of course, your head and shoulders under the neckline, gap close, and then back to the 200 in here. That's 607.25 as a key level. Moving along to Tesla. Let's take a look at Tesla. I like the reversal. I like the fact that this double bottom played out nicely. There was a good day 2 follow through trade on the Tuesday session. A little bit of a pullback happening today, undoubtedly, like everything else across the broad market. But let's just think about this. Is there room for a higher low after setting this soft higher low here, breaking over the neckline, call this a higher low double bottom? Could we still envision a higher low over the neckline at 250.50? I think the answer is absolutely. So I'm going to be on watch here in Tesla. If this pullback continues, can we get a gap fill reversal to suggest a long back up to the equal high and retest the daily 50 SMA? Not that we ever want to get into the game of trying to catch falling knives, but if you're a believer in Tesla as a technology company, not just a car company, a 50% retracement from the all-time high to its lowest low of this cycle, it's a pretty aggressive haircut. Again, not that we want to get in the battle of catching falling knives and, oh my goodness, it's a discount buy, you should add this. Do whatever you want in the long-term perspective there, but a little reprieve off of this structural low that's built out. Again, I think the key here is that we've identified technical structure that aligns with some of that more sentimental, hey, this is oversold, this is a big buying opportunity. If we have structure and sentiment, then fine. So 250.50 remains key here out of Tesla. Higher lows above look like we can participate in the upward direction. Getting a little bit of Man Ray action happening here, so anything that's underneath probably worth a quick and subtle level adjustment. And it's probably this one here, 272 flat, we could say. If we want to get crazy here, let's do it together. 272 flat. If we're underneath that, I would start thinking about thin structure retracement into this gap close area and that 250.50 retest for support to step back in there. So lower highs, and maybe this is like a scalp to the downside for all the intraday traders, and then the swing traders and intraday traders as well probably look for this back in the upward direction. 250.50. We've spent enough time on it. Let's move along to JP Morgan. A little bit of strength in the financial sector as we've noted today. This inverted hammer happens over the top end of this previous range. This is the election gap up. I've got to say, I'm impressed with financials. I hope that I was very clear about that in our analysis of the XLF. And just the idea that a higher low can now form is much more compelling than some of the other tech sector charts that we've been looking at so far today. So financials could be the glue that hold together the S&P, and it's a good thing we have JP Morgan in our rotation to be a continued reminder of that on the intraday, right? So 248 and the gap fill reversal here at 242.35. That's really what I'm looking for potential higher lows, either consolidation and go, or if this pulls back and supports here, Brigade bolt back over the 248 is where you participate, or at the lowest low if you have what it takes to spot that setup intraday. Netflix, color me impressed as well. I was really a little bit more so looking for this consolidation up against the neckline of the head and shoulders to offer a rejection back to the downside, big lower high, especially with all the weakness we were seeing in the tech sector and the broad market as a whole. And like I said, color me impressed. We did get up and over that 966.85 on Tuesday, retraced it today. It needs to hold. If we get an equal high, that's where the door is open for upside. This is just a big old overshoot and a higher low in the grand scheme of things in this trend, right? You could probably zoom out to a weekly and build the argument for that, but regardless, those are the levels that we're using into the end of the week. Let's get into these 4 trade ideas because I think they're pretty compelling and interesting ones. Let's go to PLTR. Palantir, the fan favorite. This, as inverted head and shoulders, of course. Neckline is clear as day. 50 SMA is meeting for confluence. A little bit of a lower wick from today's session. If we can spot longs off of 90.75 and PLTR, I think that's a great opportunity for a risk-reward long on the whole premise of Brigade Bolt that looks like this. Target up around $100.50. This has been a fan favorite. It's pulled back aggressively after the euphoric earnings blow off top, if you will. I think if it's going to form a structural low and continue its chugging along in the upward direction, now is the time to do it. Market finds a little bit of a floor. If the market's broad market-wise is bullish, PLTR 90.75, very interested. Let's take a look at the next one. Speaking of P's, let's go PYPL for PayPal. This is a classic look above and fail. You could see it miles away on the daily time frame chart. The trend is down. 50 SMA is down. We're under the daily 200. The y-axis, the price range here, is not all that great, but the structure is just so pretty, right? Look at this consolidation. Look at the acceptance above for 2 days, and hardly acceptance, right? Gap and faded the gap all day. Tried to rally, faded on Tuesday. Tried to hang out near the highs, faded through the opening print, accepted underneath 70.50. Let's go to the hourly. If you take a look, right? Call it a triple top, call it whatever you want to call it, it doesn't matter. Any lower highs underneath, this is ultimately the idea. Risk reward, 70.50 into 67.50 out of PayPal. Bearish trade setup happening here. I would not want to get involved on the long side if it starts breaking over 70.50. This is not one of those ideas that could go either way, primarily because of the daily trend strength to the downside. Next up, let's take a tour outside of some of the tech-oriented stuff and move over to J&J. And what do we see over here? This is a bearish setup for a head and shoulders, maybe a Man Ray, if you will. Regardless, the neckline is here. It's a bearish 3-bar play to the downside, right? An inside inverted hammer after the big bearish breakdown on Tuesday, which is counter to the hold that we saw in the broad market. And notice the upper wick rejects the neckline. So 161, who let these numbers slide? Who let these numbers slide? My goodness. Oh my, whew. Let's start cleaning some of this up. You guys know the deal, round numbers only up in the office. That's almost unbelievable. Let's just quickly clean this up, otherwise it's going to drive me nuts. I know it's probably not how you want to spend your time, but we're doing it. There we go. Those are the quick updated numbers. Let's take a look. Here it is on the hourly, right? Let's get the zoom correct. Very classic Brigade bolt. Here it is, looking for downside. Risk reward 162, 159.65 becomes the target. That's a helper level, very small level from back here. And realistically, we'd be looking for 157.75 on a stronger push to the downside. Something that looks like this, daily 50 SMA as a retest, and then changing tone when and if we approach that level. So that was one step away from tech. Let's get even further away from tech. NEM, Newmont, whatever. Gold miners. Gold we know has been on an absolute tear. What's this setup? I don't know about you, but it looks like a little bit of a cup and handle. Call it a rounded bottom with a higher low. It doesn't matter what you want to call it, but I think this is very interesting, especially noting what we have off to the left. We don't often talk about gold miners. We don't talk about gold, outside of maybe expressed as a currency, is it risk on, risk off. So this chart here is sort of outside the scope. I'm not going to pretend to be a metals expert, a commodities expert. There's a big difference between trading gold outright and the miners themselves. There's a number of different implications that the miners are subject to versus the actual raw price of gold. So please understand that if you want to get involved in this. It's not going to move one-to-one with the GLD or something like /GC futures, but the chart setup here is very interesting with the earnings breakdown from back here. So over 48.90. I'm not going to sit here and say that you've got a thin structure retracement in one day. We're going to make it, oh, look at that. Thinkorswim gave us the beautiful level. Love when that happens. 55.75. I'm not saying that this is going to happen in one day, but it might be worth some sort of long position or some way to try to express a long thesis on Newmont here if we can get a move over that 48.90 with what's going on with gold. Maybe that acts as a tailwind. Again, please be aware of the differences between miners and the asset itself. But that is where we'll leave it off for today's episode of the Midweek Market Update. So I hope you enjoyed it. I hope that we can get some resolution of whether or not this is a firm trend reversal or not from the S&P Daily. I think we'll have our answer within 48 hours, pending the close of the weekly candle, as we kicked the video off with, are we over or under the do or die level? As of Friday at 4 p.m., we'll watch it together. We'll do the pre-market prep as we typically do every morning, 8 o'clock Eastern time here on the channel. Come hang out with us. We will have coffee and donuts for the PCE announcement, 8:30 on the Friday session. We'll see you there. Have a green trading week, and I will catch you in the next one.